Everyone, it's Dale Anderson here. Hope you're well. So I just wanted to update you on the latest news about the Federal Reserve and the Bank of England. Both just raised interest rates by another 0.25% base points, which means we're now sitting at the highest interest rates we've seen since early 2007. And with the Bank of England increasing rates to 4.25% and the Federal Reserve to 4.5%, apparently this is just the beginning. After all, home prices have now posted the first fall for the first time in 11 years, however, still up from the pre-pandemic levels in the UK and the USA. Banks like JP Morgan have warned that we are already past the point of no return, and the Federal Reserve and the Bank of England have indicated that they are nowhere closer to being done. That is why it's important we discuss what they say is going to happen in 2023, the new changes taking place, and which of your investments are most likely to be affected. So before we talk about the most recent rate hike and the Bank of England outlook for the rest of 2023, we have to talk about the latest inflation report. So once you understand this, everything will start to make sense. Before we do this, please click subscribe and like my channel for further news. There's a link below where you can get a free newsletter and find out more about some of the investments and properties we can offer. So let's talk about the inflation problem. Throughout 2022, the Bank of England and the Federal Reserve increased rates from 0% to 4.25% and 4.5% respectively, fastest rate hike ever in history. As a result, inflation has steadily been falling from its peak of 9.1% back in June 2022. However, it's still nowhere close to being over. That's because on March 14th, the latest inflation report revealed that inflation is still up 6% in the USA and a staggering 9.2% over the same period in the UK, according to the Office of National Statistics, with prices rising 0.4% from the month prior in February, implying that if we stay on this trajectory, we could potentially see sub 5% inflation this time next year. I realize we're getting ahead of ourselves. We can't assume things will continue indefinitely at the same pace, especially as we've seen with Silicon Valley Bank. Anything can change at the moment, like the Fed's skyrocketing balance sheet. In terms of what's leading inflation, none other than housing. The overall cost for housing has risen by 0.8% month on month, or 8.1% year on year, which is a big deal when you realize that housing makes up a third of overall inflation reading. In fact, UK house prices increased by 9.8% in the 12 months to December 2022, according to the UK House Price Index. When you dig a little further, you will see the rental index rose also shows rents risen by 0.8% in February and owners equivalent rent rose by 0.7% over the month. Whilst in the UK, private rental prices paid by tenants increased in the UK by 4.4% in the 12 months to January 2023. Suggesting that inflation is going to stick around a lot longer than expected. The good news is that rents are often seen as a lagging indicator because the data we have today is often a reflection of deals and leases signed months prior. With rents potentially beginning to drop, chances are that it might reflect in up-and-coming reports. On the other hand, in the UK, brokers finance predict a 12.91% rise across the UK due to persistent pressure on first-time buyers, inflation, and high demand, which is pushing rents up even further. In fact, the Royal Institute of Chartered Surveyors in the UK are also claiming rents will increase as much as 15% in 2023, making the cost of living crisis even worse. In terms of everything else besides food, which increased by 9.5% over the last year and 0.4% from a month on, other items declined, like energy and gas were down 0.6%, used cars down 2.8%, medical services down 0.7%, which is a really good sign inflation may start to come down. So next, let's discuss interest rate rises. In terms of the recent hike rates and what we discussed, a lot is about to happen. This brings me to an interesting article from the New York Times with the headline, "Low rates were meant to last. Without them, finances were in for a rough ride." As they explain, in the 2010s were the era of 2% for interest rates. Inflation and growth were all around the same time until, of course, something broke. In this case, Silicon Valley Bank was one of the first dominoes to fall because the Fed's rapid interest rate increases caused their bond values to drop during a time when venture capital was drying up, and during a time when company expenses were also going up, causing their portfolio to take a massive hit, although it seems that this is not an isolated situation to one bank, as you can see with the situation with Credit Suisse. It said the US banks were sitting on $620 billion in unrealized losses from securities that had dropped in price at the end of 2022 as a result of the Federal Reserve. From there, they're going to explain that rising interest rates have been a recurring source of financial pain across the US and the UK economy, with sharp rate rises causing the saving and loan crisis throughout the 1980s, the bursting of the dot-com bubble throughout the early 2000s, and the decline in home prices during the 2008 financial crisis. But even with a series of disastrous events behind us, some say the Federal Reserve or the Bank of England could see rate rises to 6% by the end of this year. That's what leads us to what happened last week. The Fed and the Bank of England raised their interest rates by 0.25% despite the banking turmoil we have seen in the last few weeks. On broad scale, they've indicated we could have a peak federal funds rate to 5.1% by the end of 2023, suggesting we may have further 2 rate hikes ahead of us on May 3rd and June the 14th in the USA. Then it will be up to them to take a wait-and-see approach if inflation begins coming back down. Whilst the Bank of England is saying there may also be further rate hikes before interest rates start to come down again. If it does, it's expected that the hold rate's steady for the market to adjust, and if it doesn't, good luck, because rates will go even higher or stay the same for longer. If things stay exactly on track, we may not see a reversal anytime this year. On a positive note, even though they did revise the GDP numbers downwards, there is no reason to expect a recession according to the Bank of England and according to the Federal Reserve. That is because they expect the unemployment rate to exceed much more than 4%, and in the process, we can avoid the hard landing that so many predicted. Who knows if this will come true? According to their reports, this is all positive for the economy. In addition to that, Jerome Powell also indicated that the banking crisis had a similar effect to an additional rate hike because lenders are pulling back and credit conditions are tightening. Of course, they also recently had the spring budget in the UK, where the Chancellor has announced that the economy and inflation is under control and may come down at the end of the year, and that they are looking on track for one of the lowest unemployment rates. In a way, this allows them more room to take a step back from additional rate hikes because the economy is slowing down one way or the other. In the big picture, they will likely increase base rates 2 more times at 0.25%, then hold them there for the rest of the year until inflation comes down. This leads me on to our next point, the housing crisis. In terms of the rest of the market, look no further than housing. For the first time in 10 years, national home prices saw a year-on-year decline of 1.2% in February to $386,721. The first year-over-year decline since 2012. Prices declined as sellers responded to a drop in home buyer demand spurred by elevated mortgage rates. To put that into perspective, as Redfin explains, just 44.9% of homeowners that went under contract in February did so within 2 weeks, down from 60.2% 1 year earlier. In addition to that, new listings coming to the market were also incredibly low because many homeowners have already locked in their interest rates, known as the lock-in effect. Goldman Sachs reported that 99% of outstanding mortgages had interest rates below what is currently being offered, and 63% of those loans are between 2.5 to 4%. So current homeowners have little incentive to sell their homes, which have a low interest rate right now compared to the significant interest rates if they decided to move or sell, especially for the 28% of those that have rates below 3%. On top of that, if a homeowner paying below 3%, prices would have to drop by 35% for that same home to value the same monthly payments as today's current rate of 6.5%. It wouldn't make sense to sell unless they really had to. Of course, that doesn't mean low inventory is going to mean sellers will make more money. On the contrary, Goldman Sachs believe national house prices will fall 6.1% in 2023. This would be much worse than I think if it wasn't for the lack of supply coming to the market. And as we've seen in the UK, there has actually been a lot of rental inflation as well, which is keeping prices relatively high despite the slowdown. Throughout all of this, the good news is mortgage rates have been reduced since the banking failures recently, with some of today's 30-year mortgage rates dropping below 6%, prompting buyers on the sidelines to start making offers. We don't know how long rates will stay the same in the foreseeable future, but overall, some believe house prices may even start to creep back up in some areas by a rate of 3.1%, as there's still demand for housing once interest rates start to cool. That's the very beginning, as we also have the stock market to consider. The good news on the surface, inflation seems to be subsidizing, which in turn can be bullish for stocks that benefit lower rates. Not to mention the S&P 500 price to earnings ratio is back to the same levels that we saw in 2018 thanks to falling prices. On top of that, it also found back-to-back down years for the stock market are incredibly rare. For instance, the S&P 500 has only seen consecutive years of negative returns 3 times since 1957. Meantime, in the UK, the FTSE 100 has hit record highs to 7,906 points in February 2023 since it started in 1984. And this is largely due to the pound dropping against the US dollar and the Bank of England raising interest rates since 2008, suggesting we have a chance of being up again by the end of the year. That's because the stock market is very forward thinking, which means it doesn't matter what is happening today, instead what the market thinks is going to happen over the next 6 to 12 months. And if the expectation is that we are soon approaching terminal federal fund rates of 5.25% in 2024 to curb inflation, then we should be a few more hike rates away from being done. Of course, this is what analysts think is going to happen. One Reuters poll suggests that the S&P 500 index could end off 5% by the end of 2023. Barclays believe there could see a decline of 3,675 points. Morgan Stanley believe it will remain flat at 3,900. Citibank and Goldman Sachs predict 4,000 for the S&P by the end of the year. So JP Morgan is the most bullish and project 4,200 by December, but then again, Credit Suisse also said 4,050, and I guess we'll just leave that at that. To make things even more confusing, the financial samurai block pointed out that the spread between the best and worst case scenarios are the largest we've seen since 2009, with estimates ranging anywhere from 3,675 all the way to 5,000. So basically, no one has really much of a clue what's going on, and the market reacts to these arbitrary numbers, which are changing day by day, which could mean nothing because everyone is out there just making their best guess. So what I think about what happened in the meeting last week with the base rates going up, I'll be honest, I don't think we got anything we already didn't know. The Federal Reserve already committed to fighting inflation, as did the Bank of England. They're trying to get us down to the 2% target, and they don't want the entire economy to implode in the process. The bigger issue right now is simply mitigating the banking crisis. After all, Credit Suisse was once almost worth $300 billion and just recently sold to UBS for $3 billion, even despite being given $54 billion by the Swiss National Bank. Now, even though that isn't directly linked to the UK or the USA, there is a lot of overlap. And if investors think there's a problem with the banks, that could self-perpetuate. I believe that there could actually be a problem with the banks. Point being, there's a narrative that these rate hikes are making it more difficult for the banks to stay afloat. That's because they have money tied up in bonds that are falling in value, and that is why the Fed had to be very careful to manage inflation versus the overall health of the banking system, even though banks are getting as much liquidity that they need. Just look at the Fed's balance sheets. Essentially, they were able to buy out unprofitable bank loans and hold them to maturity, even though they had now taken on more debt. I know this complicates matters already, and it's a very delicate situation. That's why I believe they are likely to take a wait-and-see approach throughout the rest of the year. Remember, there's nothing that says they can't temporarily freeze rate hikes in the future and then come back to it once conditions are improved. That is why it's so important we keep up to date with the market news and diversify into things such as property. For more information, please keep up to date on my channel. I really appreciate it. Click like and subscribe. Thanks for watching. Until next time.